Hello.
Hi, can you hear
Hey.
me?
Yes, just perfectly.
Okay, fantastic.
All right.
So,
I'll be back in just 1 second.
great.
Oh, I see you promoted me to presenter. That's so. But I assume you want to introduce it first, right? With the first two slides.
Correct. Yeah, I'll do the first couple of slides and then I'll turn it over to you. And great,
Brilliant.
I see a few people have already joined. We'll wait a couple of minutes for some more folks to come on and then we'll get started.
Great. Sounds good.
All right, thank you. All right, hi everyone. As always, we'll give a couple of minutes for the stragglers to arrive. I appreciate your being on time. We'll get started in a moment. All right, I think we can get started for now, and then folks will come on as they can. Thank you everyone for joining. My name is Andrea Armeni. I'm the Executive Director of Transform Finance. And I'm really delighted to have this webinar today on an issue that I've recently come to think is fundamental to the overall work that we're doing around extractiveness of value versus value creation through finance, in particular in a community context. And and I'm delighted that we have Eli Staub joining us, who will be leading us through the bulk of the discussion. We're looking at this within the context of two issues that are fundamental to the work of Transform Finance and the Transform Finance network, investor network overall. One is the issue of extractiveness of value through investments versus the creation of value. And the other is the issue of growing wealth inequality. As we've seen in previous webinars, a pretty fundamental issue, in particular in the United States these days. So that is the frame through which we'll be looking at this. A broader frame is to look at share buybacks really as one of the instances of a very short-termist approach on the part of investors at the public stock kind of level. The last thing I would like to say before turning it over to Eli is that we haven't seen that many options, or rather, when we look at impact investing as a field of for social change, we often look at direct investments or kind of like much higher levels of engagement at a smaller scale. And we've been looking for a while at ways in which that impact could be achieved as well through our public equities, besides the divestment approach that many folks take. And I think this is a particularly interesting area for engagement, especially on the part of the asset owners that are part of the investor network that have significant public equity holdings. And I would like to view the webinar today kind of as a call to action, as a way to workshop together what can be done in terms of engagement and activating asset owners if, as I believe will be the case after Eli's presentation, you're persuaded that share buybacks are an issue, kind of working together through what can be done in a more active way to deal with this problem. So I will turn it over to Eli Staub from the SEIU. I'm really delighted, Eli, that you could join us. My own thinking on this topic has been deeply informed by what you've been doing, so I really look forward to your presentation. Thank you.
Thank you. Can you hear me okay?
Yes.
Great. Good afternoon, everybody. My name is Eli Staub. I'm with the Service Employees International Union with our research department and work with our capital stewardship department as well. We do a lot of work to engage with trustees and staff at public pension funds to engage in issues of long-termism and non-extractiveness with those kinds of asset owners as well. So I'm delighted to make this connection with you all. My goal is that from this conversation with you all today, you will leave sharing our perspective that for investors who are concerned about issues of short-termism, issues of excess extraction, and issues about investment not serving the broader social good, that you will share our analysis that share buybacks, which is a rampant practice, we will go into exactly what those are and what those do, but that you'll share our analysis that they are part of the problem, but also our analysis that there are ample things that investors, asset owners, asset managers can do to address this issue, to raise their voices in ways that are appropriate to them as asset owners. So our overview for what we're going to do here today is, number one, I'm going to introduce the issue. This is an issue that I'm sure folks have been seeing a ton in the media about. Just yesterday, there was a long-form piece that Reuters put out that was a result of a new study that the Reuters group did on this issue. There have been many groundbreaking studies on this issue, so I want to take some time to just ground us all in a set of facts and in a set of history about what share buybacks are, what role they're playing in our economy today, and how the U.S. is situated internationally. It's always an important perspective to carry as an investor. And then I'm going to talk about the issue through two lenses. One is looking at buybacks as an issue that investors, even investors who are not focused on broader social impact, investors around the country are starting to raise their voices around this issue already. So I want to frame for you some of the core elements of what those investors are finding so concerning about this practice. So we'll go through a couple of elements of why investors, as investors seeking long-term return, are concerned about the issue. And then I'll also flag some of the ways in which those who care about broader impact to society, those who care about the impact of finance on the experience of workers, consumers, taxpayers, etc., why those concerned with that level of impact are also concerned about this issue. And then we'll close with some discussion about what some opportunities for engagement will look like, which will also highlight some of the recent political developments on this issue as the issue has started to gain broader public traction as well. If you have a question or want clarification on something that we're doing, please feel free to just speak up. It would be great to have some dynamics, some back and forth in this conversation. I think you can also use a chat function that's built into the software as well, if you'd prefer to raise a question that way. But please feel free to jump in if you do have questions. So, let's ground ourselves in some recent history of our country in terms of the economy and how it's playing out for real people. I assume that none of this is new to folks here, but looking over the last 5 years, we had an economy that overall grew 12%. From those 5 years, corporate profits grew almost 50%. This is obviously since the last major crisis. And a stock market that was up over 92%. But the median household income in this country, on a real basis, had fallen by 3%. So everybody, I'm sure, is familiar with the broad debates around inequality and all the things that are driving inequality in this country. One of the things that's really quite noteworthy is that we have this diminished median household income, even during a time when labor market outcomes by other means seem like they'd be doing okay, right? There was not as high an unemployment rate as previously, from when we started in 2009. Corporations are making plenty of money, but it's not translating into real gains for your average household in this country. And so when you start to look at this, you have to start asking, well, what are the set of forces and factors that affect that? When you step back, you see that our landscape is an economy that is actually quite dominated by large firms. Small business gets a lot of airtime in the political economy of the United States. But in fact, small businesses, those employing fewer than 20 workers, employ less than 20% of all workers, even though they comprise 87% of all firms. By contrast, less than half of a percent of all firms, which are those that have 500 or more employees, employ almost half of all workers in the United States. The decisions of those larger firms have outsized impact on employment outcomes and labor market outcomes and distributional outcomes across our economy. So the decisions that those who lead those firms make really matter for the outcomes that we care about to have a more equitable society. So let's look then at the people who run those firms and the set of choices that they confront. Obviously, CEOs of major corporations in this country face an unimaginable array of complex decisions as they try to navigate the complexity of the world around them and guide their corporations through it, on the one hand. On the other hand, they also face actually a rather simple set of categories of choices about what to do as a corporation. So in the middle you see there the CEO of Exxon, Rex Tillerson, and they are effectively confronted with a set of categories of choices about what to do with all of the cash that they as corporations are sitting on. Corporations, people have, I'm sure, seen the headline numbers sitting on $2 trillion in cash. The question is, they're making all this profit. What are they going to do with the money? So are they going to invest into the corporation, create jobs through new projects? Are they going to raise wages and invest in the human capital of their workforce? Do they want to pay down debt? Do they want to issue a dividend? Do they want to buy back shares of the company's stock? They could also choose to merge with another company, take over another company, but it's a relatively discrete set of choices. And what I submit to you is that this CEO, whoever's in charge here, will make the choice that will most directly affect two things. One is their pay, and two is how they will be judged by those that judge them. Their boards, the analysts that cover their company, and their investors, particularly their loudest investors. Only one of those choices that we were just looking at directly affects their ability to perform according to those two standards that I just named, and that is buying back the company's own stock. So an incredibly simplified primer on what a stock buyback actually is. In this example, we have a company with $80 in earnings and 4 shares outstanding. Again, highly simplified, but gets the point across. That company obviously has $20 in earnings per share. The question is, once they have accumulated earnings, once they have retained earnings in the company, what are they going to do with those earnings? And one of their options is to use their cash to repurchase shares from others in the market that own them and bring them back into the company, effectively taking them off the open market. This is called an open market share repurchase. There technically are also other types of share repurchases, but open market share repurchases constitute the vast majority of share buybacks that happen today. Let's say they bought back 2 of those shares. In doing so, each of the remaining shares is now worth $40. So previously they were worth $20, now they're worth $40. Okay, so how does buying back your own stock affect the price of the stock, and why would this be a decision a CEO might make? So share buybacks can raise stock prices in a variety of ways. Number one, can raise stock prices by that mechanism I was just describing. When your earnings per share increases, but if your price to earnings ratio remains constant, then by definition, the price of your stock has gone up, because each share that remains has a larger claim on the earnings of the company. There are some other elements of that will ultimately, in a more technical sense, also affect the way that a buyback would affect the stock price. These include the fact that a company might end up with a higher debt-to-equity ratio, which, all things being equal, can offer a more attractive profile to certain kinds of investors. That would happen for a couple of reasons. One, often companies take on debt in order to fuel these buybacks, which is an issue we'll return to later. So they may have higher debt, but also when they undertake a buyback, they're actually lowering their equity on their books, and so their debt-to-equity ratio will increase. Similarly, their return on equity will also increase because of the use of cash to decrease the level of equity they're carrying on the books. Most straightforwardly, however, because those are all sort of more fundamental factors, on the technical side, as in what's actually happening in the open market, when a company undertakes a share buyback of sufficient size, they are helping create a floor under the price of the stock in the open market. So bidding up the price of the stock, which has an effect on the price as well. So folks may be familiar with the work of Bill Lazonick, who's an economist at UMass Amherst, particularly the piece that was published in 2014 in the Harvard Business Review entitled Profits Without Prosperity, which addressed the issue of share buybacks. He and his team have done some phenomenal foundational academic work on this issue, and I'm presenting here 2 slides that come from their work. What this looks at is the growth of the practice since the early 80s. And the way they did this analysis is they looked at the companies in the S&P 500. They did this in 2014, so this was 1981 to 2013, who were continuously members of that index across all of those years. right? So that they would have a firm basis of comparison. There aren't companies dropping out. There aren't new companies being added in. They're looking at the same set of companies. I think it's just under 300 companies across that set of years. In 1981, corporate profits were almost $50 billion. Dividends as a share of those profits were 45%. And share buybacks were only 2% of corporate profits. The payout to shareholders in the form of buybacks was only 2%. Contrast that to 2013. Corporate profits, $613 billion. Dividends as a share of those profits fell to only 36%, and buybacks had climbed to 46%. If you look back just on the same graph at the years 2007 and 2008, what you'll see is that actually in those 2 years, corporate profits, total payout to shareholders in the combination of dividends and buybacks actually exceeded profits in both of those years, and that the majority of those payouts were in the form of buybacks. So really a dramatic change in what corporations are doing with their cash, particularly in how much of it they are retaining to be able to reinvest in the business. The trend continues. The top portion of this slide looks at all of the companies in the S&P 500, so not filtering out by those who had come in or fallen out of the index, just looking at the current constituents over time. In 2014, you see that the total profits actually approach almost $1 trillion. 93% of corporate profits in 2014 were paid out in the form of buybacks and dividends. 58%, almost 60% of the almost $1 trillion that corporations earned went to nothing more than corporations buying their own stock on the open market in 2014. Almost $600 billion. It's astounding how much money that is. Dividends and buybacks are then set to hit even new highs, crossing the $1 trillion mark in 2015, and we have had record quarters in 2015. So this trend is going gangbusters, even as investors and others are starting to raise questions. So where does all this come from? How does it happen that in 1981 the game shifts so substantially in terms of what corporations are doing with their cash? Well, I want to introduce you to a man named John Shad. John Shad was Ronald Reagan's appointee to lead the Securities and Exchange Commission. And he was the first person to lead the SEC from the finance industry since the 1930s, actually. And he set about introducing a whole series of neoliberal reforms into the SEC, into the way that the SEC conducted its business. And among those was liberalizing the practice of share buybacks. Previous to 1981, or 1982 rather, which is when that rule was implemented, the SEC treated share buybacks as a form of insider trading, right? As a form of trading when somebody, in this case, the ultimate insider, the corporation, has more information than everybody else in the market, and it was regulated quite tightly as such. In 1982, a new SEC rule was introduced called Rule 10b-18, which if you read any of the articles, you've probably seen, that really profoundly changed the game and basically completely liberalized the rules around open market share repurchases. At the time, remember we were looking at the data, only 2% of corporate profits were being diverted to open market share repurchases. And so the line was, well, this is just not really that much of a concern. It turned out, however, that completely unleashed this whole new wave of payouts to shareholders. And it happened concurrently with a couple of other phenomena in the capital markets. One is the rise of the primacy of maximizing shareholder value as what is perceived to be the only legitimate goal of the corporation, ideology coming out of the Chicago School of Economics. And then it also happened during a time that corporate raiders on Wall Street were doing their sort of big waves of debt-fueled buybacks of such great 1980s fame. And so in line with both of those phenomena, the liberalization of open market share buybacks led companies to start massively shifting what they were doing with their capital. This new SEC rule here on this slide is juxtaposed against something that we look at quite a lot in our work here at SEIU, which is the great divergence between productivity and compensation in the United States. So this graph looks at real output per hour and real hourly compensation for workers. And what you see is from 1950 through 1980, you see that those two lines are quite tightly interwoven with each other. But that since the early 80s, we see a very substantial divergence between real productivity growth and real compensation growth in this country. There are a number of mechanisms that drive that, but one of those is this question of, are corporate profits, are the earnings of corporations being reinvested in the company in such a way that creates broader prosperity? Or are they only circling at the top in a way that benefits those who already have in this country? So I was talking about this rule and the way that the U.S. Liberalized share buybacks. In fact, the U.S. is really the only industrialized country with a functioning stock market that regulates share buybacks in this way. The U.S. has a couple of rules, or really they're not rules, they're more like safe harbor guidelines on the books around share repurchases. They've got rules around, your board has to approve them. There are some guidelines around price and volume limits. At the end of a quarter, a company has to disclose what their volume and the average price of their buybacks were over the past quarter for each month. No other major country allows corporations to use their cash in this way. The U.S. is a total outlier in its regulatory framework here. Most of these other countries have effective rules, actual enforceable rules, along most or all of these dimensions, including rules around insider trading. In the U.S., it is perfectly legal for an executive of a corporation to sell their own shares during a period while the corporation that they control is buying up the stock through open market share repurchases, effectively helping prop up the stock price. In most other countries, they say, hey, that is problematic and we need to have a real regulatory framework. The specifics of those regulatory frameworks differ across all of these different economies, but what's interesting is that when you compare the U.S. to each of these other countries, you find that the U.S. Head and shoulders stands above these other countries in terms of buybacks as a share of corporate profits across these economies. So this is from a study that I did that looks at non-financial companies in the S&P Global 1200, which is an agglomeration of large cap stock indices across major developed countries for the most part, and stripped out the financial companies from this. The reason I did this to be able to do this look-back study is because different countries have wildly different rules about how much their financial institutions are allowed to return capital to shareholders. So I wanted to control for the effect of those different national regulatory frameworks around how much those financial institutions are even allowed to pay out through buybacks or dividends. So this is looking at non-financial companies, and you see that the U.S. As a share of net income pays out more than double its next closest country on this list when it comes to buybacks. And when it comes to total payouts, the total payout ratio, the U.S. Still stands head and shoulders above all of these other countries. What's particularly notable for long-term investors here is that the U.S. corporations could both substantially increase their dividends and substantially reinvest in their own companies, and still be in line with all of the next set of countries down the line here. So they could be having a payout ratio of closer to 70%, dramatically ramping up their dividends and dramatically ramping up their reinvestment in themselves and in the economy overall, and still be in line with their international competitors. So what's driving these buybacks at this level? I'd submit to you that there are two fundamental drivers and then a series of kind of broader or secondary drivers. The first of these is executive compensation. Executive pay in this country is very typically aligned with metrics like earnings per share and total shareholder return. This has been done very deliberately by a set of investors under the theory that this would better align executive interests with the interests of those investors. And what I'd submit is that it has very effectively aligned a lot of executive behavior with the needs of quite short-term extractive investors, but not effectively aligned executive compensation with the needs of longer-term investors. Executives who are paid based on earnings per share or total shareholder return face substantial incentive to meet those targets. That is how they will be judged in terms of their own return. And there are some really staggering facts around this. A survey that was done of CFOs a couple of years back indicated that many of them, when confronted with a choice between undertaking a positive net present value project for their company, right, a project which is one of the most fundamental ways that a CFO, a CEO is supposed to make choices about what will enrich the corporation and what will enrich the owners of the corporation. About a majority of those CFOs indicate that they would choose meeting a quarterly earnings per share target over undertaking a positive net present value project. A company is supposed to accept as many positive NPV projects as they have capital budget for. That is basic finance theory. Obviously, in the real world, it gets a little trickier, but that is the core of what they are there to do, is identify positive NPV projects and undertake those projects. But the fact that they would choose to meet not to miss a quarterly EPS target because they would have to, this quarter, invest in that longer-term positive NPV project is quite troubling. It speaks to the role that Wall Street analysts and others play in policing the behavior of these corporations for the short term, and in particular, the role that certain kinds of outside investors play, hedge funds in particular, in fact, particular kinds of hedge funds, play in pressuring these corporations to deliver on these kinds of payouts. So there are lots of case studies here, and we'll actually go into one of these in a bit. But overall, this is from a study that S&P Quantamental Research did earlier this year, and they looked at firms that had been targets of activist hedge fund pressure over a period of 1997 to March of 2015. And what they found was that firms that have been subject to to campaigns by activist hedge funds walked away from those campaigns with lower operating margin, lower net margin, lower revenue growth, and lower asset efficiency. Only two metrics were substantially higher. Number one was leverage, companies taking on higher debt, and number two was companies taking on was higher payouts to shareholders, specifically in the form of share buybacks. The outside pressure from hedge funds, from activist hedge funds in particular, to force companies to try to disgorge more cash more quickly, has a profound effect not only on the companies that are their current targets, but on other companies in their industries as well. Because when a company looks at another company in their industry or with other similar characteristics to them and sees them subject to a campaign for a board seat, a campaign that calls for the company to divest itself of of a subsidiary to spin off a portion of its assets, etc. They know that they could be next. And so possibly even without direct pressure from a particular activist investor, they often will undertake these moves themselves in order to prophylactically insulate themselves from this pressure. Those are the two fundamental drivers that we see. From here, I want to actually start to dive into the issues that we see for investors. So again, if you do not even care about the broader questions of social impact as an impact investor, but you merely care about sustainable growth and returns as a longer-term oriented investor, we see many profound issues here for concern. One is the outsized effect that buybacks are having when you actually just look at the growth of corporate earnings per share, which raises profound questions about the sustainability of those earnings. So what you have here is from a study that was done a couple of years back that looked at a period of about 2 years and asked the question, how much of operating earnings per share growth in these time periods across the S&P 500 was due to organic growth, as in growth in the actual operating earnings of these companies, versus growth in earnings per share that was due to diminishing the denominator through buybacks. And what they saw was that a clear majority of the overall growth was actually due to buybacks. This holds even more true when you look at individual corporations. So this is what Walmart looks like if you just looked at their headline earnings per share growth trajectory over the last 5 years. You see what looks like pretty substantial growth, from $4.48 earnings per share to $5.07 earnings per share over the 2010 to 2014 period. However, when you factor in the effect of buybacks on the denominator, what you actually see is that earnings per share of those 5 years remained entirely flat. And actually, this is quite a conservative mode of analysis, because all this does is freezes the level of shares outstanding at a constant level from 2010. In fact, when corporate executives exercise stock options, it actually has a dilutive effect because technically more shares are issued into the open market when those options are exercised. They just simply happen to be held by the executives. And so if you were to account for that, these numbers might look even worse. So this is what it looks like for Walmart. Oops. Here's what it looks like for Exxon. What converts from a growth from $6.24 in 2010 to $7.59 in earnings per share to a mere $6.66, just 42 cents in earnings per share growth over 5 years. Very different from their headline number. So that's a first concern, is about the sustainability of real earnings growth and the illusory effect that these buybacks have. Here's a second very real concern that lots of folks are pointing to. Buybacks displacing real investment into the productive capacity of a corporation. So this is an excerpt from a study that was recently published by the Roosevelt Institute, which I highly recommend that everyone listening to this webinar go out and read. One of the things that they did was a very careful analysis, a really innovative analysis actually, better than a number of the other studies that are out there, that look at corporate investment growth since the prior recession. So taking a whole set of time periods and looking at the number of quarters since the start of that prior recession, and looking at what happened with corporate investment into the economy, and into themselves in particular, I'm sorry. And what you see is that the most recent period has exhibited the lowest level of corporate investment since the recession of any period on record since effectively World War II. There are many, many individual case studies of this, but this is actually looking at it economy-wide. here's a case study of exactly how these things take effect. Everybody here, I'm sure, is familiar with the story of General Motors and their descent into bankruptcy around the same time of the financial crisis. GM emerged from the financial crisis with a substantial set of challenges and with a famous new wage structure, a two-tier wage structure where new employees replace old employees every week at that company, making substantially lower wages than prior than employees who had been with the company previously. Along with a whole host of other issues, including the fact that they were being investigated for a series of issues around ignition. Effectively, this was a company that was confronting such a level of challenge that they couldn't build cars that weren't blowing up on people. But in 2015, this company, faced with all these challenges and all these opportunities to invest in themselves, faced a campaign by a group of activist hedge funds that amassed just a 1.9% stake in the company, less than 2% stake in the company, in February of 2015. These hedge funds threatened a proxy fight with management, basically saying, this company is not being managed well, we demand a seat on the board and a whole series of restructurings, and we demand that you pay out an additional $8 billion to shareholders in the form of buybacks. Within 1 month, General Motors settled that fight by announcing $5 billion in buybacks to buy off the hedge funds to prevent them from running their proxy fight. And I submit to you that that may not have been the best use of $5 billion for companies that are facing challenges like getting their manufacturing processes to work right, meeting the challenges of producing cars that meet higher emission standards, or producing better electric vehicles, or bringing up the bottom of their pay scale so that people make enough to survive. $5 billion to satisfy a 1-month campaign by a set of contemporary corporate raiders is an example that I think really captures this reality of buybacks displacing real investment in the economy. A next concern, this is 3 out of 4 that I'll share with you today, for investors, is that buybacks actually carry substantial execution risk with them. In other words, buybacks in theory drive up the price of the company and the share price of the company, and often do, but don't always, and are not always as potent as those who are executing them would want them to be, and sometimes work very ineffectively. And this is, frankly, due in part to the vicissitudes of the market, because you just never know what's going to happen with the market. But secondly, because companies are actually staggeringly bad at timing these investments. A typical investor seeks to buy low and sell high. As you can see, companies on balance, when buying their own stock, typically tend to buy high and then stop buying when the price falls. A set of institutional investors through the industry trade press, institutional investor, have started looking at this issue and tracking this using a methodology developed by Fortuna Advisors, looking at something they call buyback return on investment, which basically looks at a share buyback program of a company like any other kind of capital investment. It has a set of inflows over a set of years, and then has a value at the end of that project, which is dependent on 2 things: the price of the stock at that time, and the amount of dividends, basically the opportunity, the opposite of the opportunity cost, the amount of dividends that a company did not have to pay because they had purchased those shares from the market. And what they found is that the efficacy of share buybacks overall is decreasing. That buybacks are not producing the same level of pop overall, and in fact, there are many, many, many companies, this is just the bottom 10 of them, whose buybacks are actually producing negative ROI. That basically Investors would do better if those companies literally did nothing but put their cash in a CD in the bank. And finally, a major issue for investors, long-term investors, is the issue of leverage, the ways that companies are levering up to undertake these buybacks. This is a trend that is growing and increasing in its velocity. It is fueled in part by these low interest rates. The theory, of course, of low interest rates is that low interest rates are supposed to spur companies to borrow, invest in themselves, right? Invest in real projects in the economy, soak up excess labor supply, and then create a positive feedback loop through the economy. Instead, huge amounts of all of that cheap debt are just cycling through at the top of the economy, where companies are borrowing that money and just immediately turning around and shoveling it right back out the door to equity investors. So they're taking money from debt investors and immediately turning it over to equity investors in the form of buybacks. The challenge, there are many challenges with this, but one primary challenge is that at some point, those rates do not remain as high. And when that tide recedes, we will find corporations that have underinvested in their real productive capacity and are ill-equipped to meet the challenges. Many companies are starting to see their debt downgraded from previously strong levels because the credit rating agencies are simply unwilling to say that borrowing to fuel buybacks is a good use of their cash, and that they're concerned that it will leave them with excess risk. So those are some issues for people who are concerned about this issue from a purely long-term investment perspective. But what about those of us who take a broader stakeholder view of the economy? Let's think about how share buybacks affect some other key stakeholders in the economy. So first of all,
we can take a quick second there, Eli, to see if there are
sure.
any questions on that first part about the investor case that you just made.
Absolutely.
It was a lot of material that we shared. So I'm unmuting everyone in case anyone would like to speak up. Otherwise, we can continue with the presentation. The one question that I did have, so if I'm understanding correctly from a few slides back, Eli, so the US essentially has a 20% higher extraction of value than most other countries through this mechanism of share buybacks. So it was 90% over, I think, more or less a median of 70 or so. That means that 20% more of the value that is being created by the corporations is being taken out to repay investors as opposed to other stakeholders in that value creation chain.
That's correct. The only caveat I would give to that is that you use the phrase to repay investors. It's important to note that most of these equity investors have never invested in the corporation directly itself, but rather in its shares on the secondary market, which is not unrelated to investing in the corporation, but it isn't the same thing. So it's more accurate to say that they are paying out at this level to those who own shares of the company.
Yeah, thank you. Feel free to go on, thanks.
Sure. So when we broaden our view to look at some other key stakeholders, let's start with workers. How are workers affected by this issue? Well, very prominent companies in our economy have undertaken mass layoffs of their workforce in order to help fund buybacks, even during periods of substantial profitability. I put up IBM and Cisco here because they've both been in the news for this quite a bit. Cisco, actually really both of them, have been called to task for, even in very profitable years, turning around. Cisco's been basically laying off 5,000-6,000 workers every year for several years running, even in the face of record profits. IBM today employs 55,000 fewer workers than it did in 2012. And this is all in order to help fund these major payouts. It obviously hurts both the workers who are laid off and those who remain. Those who remain obviously are shouldered with a greater burden of the work and the knowledge that next year it very well could be them. Workers also pay here in the form of lower wages. So this is from a report by the think tank Demos that they issued in 2014. And they were looking at this issue about share buybacks and wages. And this example was one that really drove the point home, I thought, that if Walmart redirected the over $6 billion they had spent in share repurchases in 2013 towards investing in human capital, they could give every one of their 825,000 low-wage workers a raise of over $5, basically bringing them to that $15 an hour mark. And boosting productivity and sales. It's just astonishing what this money means to people who are earning next to nothing and who are scraping by on public benefits and who are relying on food stamps and Medicaid in order to just get by, working two and three part-time jobs. What this money would mean for them, it's just staggering. That's true for workers. It's also true for consumers. Consumers pay for this in a number of ways. So one example of many I could share is that of the airline industry. As folks might know, there's been substantial consolidation in the airline sector in the U.S. over the last couple of years as the industry went through a period of real crunch in its profitability. As those airlines have emerged from that crunch, again, more consolidated and now facing lower fuel costs than ever, we see a couple of phenomena. Number one, their share prices are starting to really climb again. Part of the factors driving that are that in 2014 and 2015, these companies collectively announced billions and billions of dollars in share repurchases that they had not been undertaking before. Consumers, meanwhile, it's been documented that consumers are, even despite the fact that we have basically lower fuel prices now than any time in, the last, 15 years, consumers are not seeing any relief in prices in ticket prices for airline flights. And the question is, okay, so where is this money then going? Substantial portions of this money from this more consolidated industry are now going right out the door in the form of share buybacks. One company in particular, JetBlue, is noteworthy. JetBlue is famous for being one of the few companies in the space that had a real kind of consumer-centric focus in recent years, letting things like your first bag flies free and other perks. They, this past year, announced that they were ending many of those perks that consumers found so compelling in order to generate an additional, I think it was $200 million in revenue. I can't remember if it was 2 or 400. And where was that revenue going to go? That revenue, they also announced, was going to go to share repurchases. Taxpayers also pay. Taxpayers pay in a variety of ways. But one of the ways I want to call out is the ways that companies go hat in hand to the government saying, oh, well, if the government doesn't invest in our research and development, then we won't be able to fund the future. Pharmaceutical companies are not the only companies that do this, but they're famous for this, right? Saying, well, not only should the government be funding R&D, but God forbid the government negotiate as a payer for Medicare for drug prices, because, well, that would just harm innovation, and then we wouldn't be able to come up with the drugs we need to come up with. The CBO, the Congressional Budget Office, scored that over the next 10 years, the federal government could save $116 billion if it negotiated drug prices more effectively with Medicare. In half that time, in just 5 years, pharmaceutical companies spent that much, these are the pharmaceutical companies in the S&P 500, spent that much on share buybacks in half that time. There is money for innovation. There is money for good services for consumers. There is money for workers to live a decent life. The question is, why are corporations not making the investments they could be in a way that would actually serve their broader social purpose? And a big portion of the answer is these massive payouts to benefit short-term holders of this stock. And finally, from a just broader stakeholder perspective, the question has to be asked, well, who's benefiting from this? If buybacks are in fact helping prop up stock prices, isn't that good? Don't people own stocks? Doesn't that help people who own stock? Well, the truth is that only 14% of Americans actually directly own any individual stocks. More U.S. families own cats than own stocks. And when you incorporate everyone who's got even any exposure to the stock market through either a direct contribution or a defined benefit plan, less than half of Americans have any direct exposure to the stock market at all. In fact, stock ownership is incredibly tightly concentrated. The top 5%, only 5% of families in this country own about 2/3 of all the stock in this country. So these gains are not being equitably shared. So to sum up, there are a couple of winners. Executives whose pay are linked to these metrics win because even if decisions they make might leave the corporation weakened for the long term, typically, I think the average CEO, don't quote me on this, the average CEO tenure has fallen in recent years. I think it's about 4 years. It might be a little bit more. And so executives typically have moved on. And speculative and short-term investors also can win big from this. But long-term investors, workers, the unemployed, companies themselves for the long term, taxpayers and the economy overall are made worse off for these rampant excess stock buybacks. So with this as the backdrop, what can asset owners and asset managers who care about the long term and who care about broader stakeholders in society, what can they do? I'll submit a couple of things. Well, some are already starting to engage. So this is Larry Fink, very famously. He, at the end of last year, put out a call in an open letter to the entire S&P 500 about how too many companies are cutting capital expenditure and increasing their debt in order to boost their payouts to shareholders, and how those payouts can jeopardize companies' ability to generate sustainable long-term returns. So some investors are starting to speak out, most prominently the head of the largest accumulation of capital in the world, which is BlackRock. This issue is also starting to draw some additional regulatory, popular, political, and international scrutiny. So Senator Tammy Baldwin, Senator Elizabeth Warren, and others are really starting to talk publicly about this issue. Every one of the candidates on the Democratic side for president has started to address the issue of buybacks. Hillary Clinton in her framework around short-termism, and even Ben Carson. It was a little off in the way that he described it, but even Ben Carson in the last Republican debate brought up the issue of share buybacks when talking about banking regulation. Again, it didn't quite fit, but even on that side of the ledger, they're starting to engage on the issue a little bit as well. What you see in the top right of this slide, Bill de Blasio, when he went on Jon Stewart a couple months ago to talk about a network he was involved in that was putting forward a platform around confronting economic inequality more broadly, Jon Stewart pulled out that famous Harvard Business Review study that I referenced earlier, and laid it in front of him and said, well, Mayor, what do you think about excess share buybacks? Because people are talking about this. And then in the bottom right, you see Andy Haldon. He's the chief economist of the Bank of England, and he's starting to call this out both in the U.S. and about UK companies as well, If you recall from the slide that Andrea called our attention back to a few minutes ago, this problem isn't even as big in the UK, and abroad they're starting to say, actually this is really starting to get excessive. So Senator Tammy Baldwin, I mentioned, has been engaged on this. She's actually been taking a real leadership role here, and she reached out to the SEC. She wrote a letter to Chair of the SEC, Mary Jo White, to ask her to clarify how the SEC looks at share buybacks. And quite notably, the SEC sent her this response. It was just a two-page letter. And in this letter, they effectively said, you know what, we really don't actually regulate this practice in any meaningful way. Like Tammy Baldwin's letter, Senator Baldwin's letter, mischaracterized the way that the SEC approached this issue as a set of rules or regulations. Really, the SEC clarified, we just look at share buybacks as a form of a safe harbor, right? The only guidelines we have are safe harbor guidelines. In other words, even if a company trades outside of the price limits or volume limits indicated within the safe harbor, that doesn't mean that they are violating securities law. Or given that the SEC doesn't even monitor this in any meaningful way, that wouldn't even be a red flag that the SEC would catch, because the SEC does not systematically collect data and review it about share repurchases. So how can investors engage? What are some of the paths forward that investors can use to engage here? I'd submit that there are four. One is around company engagement. Direct engagement with individual companies or groups of companies to, number one, communicate priorities that investing in the long term is really important. It's going to matter. It's going to matter for the sustainable growth of those corporations. That's an important message to communicate overall. And I'd say that that's a very important message also to communicate at key moments. So at a moment when a short-term shareholder is pressuring a company to disgorge more cash, other investor voices can play an outsized role. So this happened, I think it was last year, when Carl Icahn was taking a run at Apple, trying to get Apple to do a massive payout in buybacks. When Ann Simpson from CalPERS actually spoke up and said, actually, this is not going to be good for us. And she wrote a letter saying that we don't think this is the right path forward for the company. It didn't stop the buybacks altogether, but it certainly blunted the amount that Carl Icahn was demanding by creating that, the space for management to contend with the fact that actually there were competing investor voices making competing demands on the company's cash. That the company wasn't boxed into a position where they were just saying, well, our investors demand this. That in fact there was dissent among their investors, and that matters for the outcome. I'd also say that there may be opportunities to build coalitions with some company executives, current executives, retired executives. Some executives are just fine with this system the way it works, but many I think are not. Many would rather be able to undertake the bigger long-term kinds of projects, the more visionary, forward-thinking projects, but feel constrained by the need to meet these quarterly EPS targets and constrained by the fact that they will be held to task if they are not disgorging as much of their cash as possible to those who own their shares. So while an executive would always be in a position of needing to defend to the hilt their own decisions around share buyback, there may be opportunity for them to speak publicly about the practice overall and whether they think buybacks are the right use of cash in their industry or in the economy overall. And in addition, some shareholders, some pension funds and SRI funds in particular, are starting to look at shareholder resolutions that they can file in order to get engaged with companies around some of the specific ways that this issue makes itself manifest, specifically about the link between buybacks and executive comp. So saying, well, maybe it's not such a good idea to use earnings per share as a metric for determining bonuses if we're not controlling for changing number of shares outstanding due to share repurchases, that kind of thing. A second way that investors can engage is in the hedge fund selection process. A subset of hedge funds, these particular activist funds, are really the drivers of this practice, and asset owners and asset managers have an opportunity to say, well, maybe that isn't necessarily the right path forward for our portfolio. A third thing that investors can do is make their concerns known to regulators. The SEC has investor relations committees that, and the SEC can also take concerns in the form of letters and other outreach from investors about market-wide practices. This form of kind of market-wide, this is a market-wide issue, and in fact, based on our review of the literature, it seems like while some are calling for for just a total ban on open market buybacks, there are a number of steps that the SEC could take around disclosure, around real price and volume limits, around around allowing shareholders to have a greater voice in approving or disapproving of these plans, and in particular, making it that executives are not, basically more tightly regulating insider sales during periods of buybacks, that there are a number of steps that the SEC could take. The SEC would have to go through a rulemaking process, but they do not, this issue could be addressed by the SEC without any act of Congress. They can make their own rules on this issue. While they would have to go through a formal process to do so, there's nothing stopping them save for the will of the commissioners on the SEC to undertake this. And finally, given that there are a set of elected officials, and in particular those running for the highest office of the land, who are out talking about this issue, for them it is very helpful to understand and to be in dialogue with investors who are concerned about extraction in the capital markets in general, and this particular mechanism of extraction and how it fits into their priorities, and to how they'll be putting together their policy platforms, and what they'll be emphasizing in their campaigning. So with that, I will turn it over back to Andrea.
Thank you so much, Eli. It was fascinating. It's I really appreciate the clarity with which you can help us navigate through this fairly sophisticated set of issues. I still have the curiosity around this on why it is that we don't have more. I mean, you mentioned that this issue is starting to come up more in the public sphere, but I still get the sense that most let's call them medium-sized asset owners and even asset managers, from my review before putting this together, are not really viewing this as a major topic. So is this sort of awareness type of effort something that needs to be done, or are there deeper reasons for why this is not a more consistent topic for asset owners and managers?
That's a great question. I'd say that awareness is a big component of the roadblock here. And related to awareness is the fact that we operate in an economic mindset that articulates that the purpose of the corporation is to pay out cash to shareholders as basically rapidly and voluminously as possible. In other words, that the corporation's job is to be giving money to shareholders as constantly and as much as is possible. And a corporation has many roles, but in particular, I think a corporation also has very substantial roles to be making investment in itself and in the future in order to meet the needs of its stakeholders. So I'd say that part of the reason that awareness is such a big issue is that on the surface, until this issue became so egregiously large, right? Until we had basically the 2007 through now cycle, where these payouts have have gotten just to such a phenomenally large degree of overall corporate profits. I think this was the kind of thing that people said, well, okay, well, this is corporations doing what they're supposed to do. Some people started to raise concerns in the 2000s, but by and large, people just said, well, isn't this what they're supposed to do? I think now it's becoming a lot clearer how much corporations are underinvesting in the future, and the amount of leverage that corporations are undertaking in order to fuel these buybacks is also really calling attention here.
Great. So I got a couple of offline comments here from participants that this is a lot to digest. So perhaps we can postpone the issue of workshopping this. I'd be happy to put together a few notes and share them with the group and see if somebody has ideas on what role asset owners in particular and even some of the pension funds can play. But before we close, I wanted to open it up for a moment to questions or comments. If anybody has anything that they'd like to share. Well, Eli, I think you did such a tremendous job that we have actually clarified the issue. I personally am extremely committed to following through this with our investor network and see if we can galvanize and organize a common voice, perhaps mainly of prominent asset owner types that might have some political clout as well. And yeah, I think as a first next step, probably sharing out some of the notes from this and seeing who we can get interested in taking a more active role would be a good step forward.
Great. Well, it was a tremendous pleasure to be with you and this entire network today, and I look forward to engaging with you all more on this in the future.
Wonderful. Thank you so much, Eli. I really appreciate your joining us today.
Thank you.
Take care.
Take care.
Bye-bye.
Bye.